Hello and welcome to the Switzer Income Masterclass on the Hunt for Yield. I'm Paul Rickard. Joining me today is Dr. Don Hanson, the Managing Director of Plato Investment Management. Don, welcome to the program.
Welcome, Paul.
The Australian Reserve Bank recently cut its interest rate to a record low of 1.5%, and they've followed leads from central banks around the world of cutting interest rates to stimulate demand and drive economic growth. Does this mean interest rates are just going to stay low for a lot longer than anyone was anticipating?
We certainly think so. I mean, clearly we've got negative rates in many countries, we've got lower rates here, and the pace of increase in rates in the US is expected to be much lower than, or slower than it has been. So yes, I think it's a lower for longer, and we've been saying that for the last year or so actually, so it's not surprising to us, and in fact potentially another rate cut could come here later in the year.
And Don, do you think these policies are starting to work? Are we seeing evidence that the impact of lower interest rates is really driving economic growth?
Well, it's very slowly at the moment, but I mean, I think the alternative was if, we'd be in a very bad state if they started to increase interest rates. So yes, I think it'll slowly start to work, Australia's certainly in a better place than most of the rest of the world.
And how have you changed your approach to investing in this low interest rate world?
Well, we haven't really changed our approach at all. I mean, we're very much an equity investor, so the same way we pick stocks works, and we pick stocks for income.
Don, Plato has a very successful shares income fund. Could you tell me about the objectives of the Plato Australian Shares Income Fund?
Yes, well that's where I think we're a bit different to many funds. We have dual objectives, both to one, beat the benchmark, so outperform the market, but also deliver high yield along the way. And it's aiming for around 3% more income than the market when you include franking credits in that. So it translates to around 9% income after fees.
And it's designed for particularly low tax rate investors, is that?
Yes, that's true, and that's another feature of the fund. It's actually designed for pensioners, so who are tax-free but get the full refund of franking credits. So it's trying to maximise those opportunities for pensioners, who of course need to live off that income. And
how's it performed since you started this fund up?
It's been a solid performance, outperformed the benchmark after fees since inception, and delivered on its income objectives.
One of the things I noticed is you have a global shares income fund. So why would an Australian investor go offshore to look for income?
Well, it's interesting. We got a lot of feedback. A lot of people like our domestic fund, said great, it's good, but they said to us, look, there's really nothing in the global equity market. And of course, you should have a well-diversified portfolio, not just everything, all your eggs in the Australian basket, but some in overseas assets. But typical global equities only yield about 2%. So we actually had a few clients come to us and say, can you do something, can you actually manage a fund like you do in Australia on a global scale? We did quite a bit of research to make sure we could do it, and in fact that's how we developed that fund. And so it's got similar objectives. The difference is no franking globally, but we're still aiming to get about sort of 3 or 4% more income than the global equity market, which translates to around a 6% cash dividend yield.
And does that mean you take on some particular sector or country biases? How do you approach looking at the universe of global stocks for income?
Yeah, well that's an interesting feature of both our domestic fund and our global fund, is that we don't have to, say, go overweight banks or overweight utilities, which are typically high yielding stocks, to develop the sort of high yield than we have. We use an active strategy to actively seek out stocks that pay dividends, and we turn that portfolio over more than most managers. But because we are managing for zero tax investors who don't pay capital gains tax, then they can afford to take a more active approach and to actually manage funds for income pickup.
And in terms of offshore, I mean, how's the fund been performing so far?
It's been performing well as well, so it's above, I mean it's only early days now, it's been going for about 8 or 9 months, but it's actually above, more than 1% above index after fees, and it's delivered about 5.5% income over that time period. So it's well on track for both its targets to beat the index and deliver more income along the way.
And notwithstanding the lack of franking, I mean you don't see that as investors haven't said, look, I don't really understand why I would invest offshore for income?
Well, I think the issue is, look, we love Australian shares and we've got a lot of clients that love them, and yes, great income, high levels when you include the franking in there. But as I say, you look back to the risk point of view, you can't have all your eggs in the one basket. 50% of the income, or more than 50% of the Australian income of this ASX 200 comes out of 6 stocks, 4 banks, Telstra and BHP. Incredibly concentrated, and if we have problems with the banking sector or what have you, then your income's going to be under threat. You look globally and you've got a much broader universe, you've got thousands of stocks to pick from, so we've got a much more diversified picture. So You do give up the franking, but you actually have got much more diverse opportunities and a much more diversified income stream.
So potentially perhaps a lower income but a lot less risk than you might have if just looking purely at the Australian market for income.
Yeah, certainly concentration risk is much lower. I mean, domestically we may still have, without index weight banks, and we still have like 12%, something like that in CBA. Globally, we actually invest in about 200 stocks, and the biggest position is about 1% of the fund.
How does someone go about investing?
Well, it's a managed fund. They can invest directly into it. They can invest via platforms. Minimum investment's $30,000, or you can even buy it on an M fund, actually.
Don, Plato's a professional manager, you're an active investor. What are some of the pitfalls that people like I fall into when looking at dividend yield when thinking about stocks?
Well, I think the most key issue that you've got to get right, or thing to avoid, is what do we call the dividend traps. You don't necessarily want to go out and buy the stock with the highest yield in the market, because often, if a stock paid a big dividend last year, but its share price might have fallen in half, it's going to be trading on a very high yield, but it's probably the stock you want to avoid. So, looking at the highest yield stock is not necessarily where you're going to get the best income. What you want to do is buy stocks with sustainable income, and if anything, avoid the dividend traps, because you can have, in domestic sense, people might remember Metcash, came out last year and announced it wouldn't pay a dividend for 18 months. And so it was trading on about a 10% yield before it made that announcement. So a lot of investors might say, yeah, let's go and buy that stock, it looks cheap. But obviously it's not very cheap if it comes out and says, I'm not going to pay any dividend at all. Share price falls about another 30%. You get zero income and you've lost 30% capital. So avoiding those dividend traps, I think, is a key to dividend or yield investing.
Well, I think you shared something really insightful there about thinking about the offshore market as a potential place for dividend yield. And clearly, your product is one way to do that, and it's got a lot of traction. So, Dr. Don Hanson from Plato Investment Management, thank you for joining us. That's it from this edition of the Switzer Income Masterclass on the Hunt for Yield. I'm Paul Rickard.